fact, let's start on property. So I guess the question I have is there's trying to strike a balance between supporting the market and not going back and creating or recreating the old problems. From what you've seen so far, is this as far as they can go to strike that balance?
Yeah, in fact, when you sort of look at it, they try to, sort of manage stabilize growth. Okay, that's one thing. They don't want to see a lot of property companies, in bankruptcy. But and also property sector and also the relating sector account for 30%, 33% of the total GDP. So all these, sort of backgrounds that explain to you why they decided to potentially supporting the M&A. Okay, they are now not trying to save every single property companies. What they want to see is the overall activities continue to be stable. They probably would be seeing more of the stronger, potentially government enterprises supporting and buying out some of the companies that are having financial issue. So all these sort of loans release, that's the sort of directions they're moving towards.
Okay, does this give you enough confidence, not so much to start recommending buying the high-quality names, but the lower-quality names, because that so far seems to be where the value is, whether that's equity or credit?
Yeah, I mean, the bigger names, obviously, if you look at it, some of the SOE has gone up by, 28, 17%, that sort of range year to date. But if you look at the other private enterprises, that either they have or have not declared of financial difficulties, they actually still down by 20%. So these sort of range will stay because, as I said, they are not trying to be a white knight to save all the companies. What they want to see is property activities, construction activities to remain relatively stable. Completions, that's crucial. They want all the pre-sold homes to be completed as scheduled, not affecting the local people feeling of owning and using the property. But the bigger, the stronger names will continue to outperform the weaker names.
And Eva, do you think what we heard from, I guess, our reports of these state-backed funds buying up stocks now, large caps, so to speak, does that benefit the property side in any way, you think?
Well, I think as I said, all these fundings, it's actually supporting the M&A, which, that even some of the weaker companies, they do have very good quality assets, but because of the free, the free threat, the free control, in terms of every single company's what sort of gearing you can take, so that also covers the government enterprises. But with the lift earlier on, not this time, the earlier on that they said that M&A is not counted, that already have helped the M&A to strike between the government or the bigger enterprise versus the weak ones.
And what signs are you seeing now that perhaps maybe it's time to get more into offshore equities? I know that, are you seeing signs that at least southbound flows have normalized in any way?
I think the key at the end of the day, it's last year we have a lot of regulatory noises that affect the market. People basically do not pay too much attention on corporate earnings. Last year, earnings growth actually is still in low teens. It's not too bad. But when we move to 2022, regulatory noises or all the announcements, it's already there. People now knowing how to live with it. They change their operations, here to this new regulations. Now it comes to a point that people will start to focus on the economic and the corporate earnings growth. Remember, we have to understand this year, first quarter, China economy, it's going to be really weak. Or maybe into early part of second quarter, we're going to see a rebound and recovery more and starting from second quarter, late second quarter, and into the second half. So corporate earnings will be one of the key signposts in terms of when we'll see at least we start to see the upward revisions of earnings. That will be also a crucial signpost that we'll be looking for.
Right. And does any sector in particular stand out to you as something that's worth watching as far as those revisions are concerned? Because the market overall is already quite cheap.
Yes, agree. Like when we look at it, there's basically two directions where we don't just look at valuations. We have to understand first where the government policy is directing and is supporting. Okay, that's crucial. So, i.e., the structural opportunity in net zero transitions in intelligent infrastructure, i.e. that refers to like renewable energy, EV, 5G related sectors. These are where the policy supports will be. And then another part, it's on along the line of valuation. New economy sector valuation is cheap. They are already pricing a lot of the regulatory risks. So when we'll see their revisions start to turn positive, or at least the negative revisions sort of stabilize and narrow down, that will be another points or key signposts that we're looking for.